Welcome to FinTech Impact. This podcast is an exploration of the financial technology world, interviewing different FinTech entrepreneurs about what they do, their story, and what their impact is on consumers, incumbents, and the industry as a whole. Here's your host, award-winning financial planner, university lecturer, and writer, Jason Pereira.
Hello and welcome to FinTech Impact. I'm your host, Jason Pereira. Today on the show, I have Sam Kawtharani. Sam is the CEO of Corl. Corl is a company that helps businesses raise funds through the royalty model as opposed to debt models and uses blockchain as a back-end system for enabling that. And with that, here's my interview with Sam. Hello, Sam.
Hey, how's it going?
Good. Thanks for taking the time today online. So Sam Kawtharani of Corl. Tell us about Corl.
Sure. Yeah. Thanks for having me. And I would love to tell you more about Corl. So basically what Corl is, we're building a revenue sharing investment platform to kind of build and minimize those inefficiencies of traditional finance, and especially at the fundraising process. And we're using automation, artificial intelligence to establish that. We're basically making it easy for startups and small businesses to access fast, fairly priced, and entrepreneur-friendly growth capital without the hassle of giving up equity, board seats, or control. And the way we're building all of that, and the interesting side of things is we're launching a security token that's going to be the world's first public company once we have the regulatory approval.
Okay, so we have a couple of things to talk about. Before we get to there, let's talk about your history. What did you do before you started Corl, and what led you to start it in the first place?
Cool. Yeah, I've been in fintech before fintech got popular. But let me backtrack a bit. And before that, so I'm originally a software engineer. Slowly found myself in product management, especially in the finance industry. I still can't even remember how I ended up in finance or fintech. It sounds like vague memories, but I started in the payments industry with Pivotal Payments in Canada, in Montreal. And shortly after, I joined a startup called IOU Central, or IOU Financial right now. I was their head of product, employee number 4 or 5, and focus on owning the whole product strategy from A to Z. And then we went public in 2012. And then by the time I left them, we had $500 million assets under management in 2016. And that's when the whole Corl idea started developing, and that entrepreneurial bug kept growing and growing until one day I just showed up and was like, okay, I'm done. I'm just going to go do my own thing. But it still all started with the idea of how we can help startups and small businesses get better access to capital. What a lot of people did not notice in the alternative and peer-to-peer lending space is that, yes, there was a lot of innovation on the technology side, the way businesses applied, or how there was that online portal where you don't have to do paperwork anymore. But the end product itself wasn't very innovative, right? It was still a term sheet loan, same criteria that the bank would look at. The only difference is you now just have a website that you're doing all of that on. And that's when the whole idea started coming up to life, where, okay, well, surely we can do something better about the product itself. Forget about the technology for a second, the product itself. And that's when I guess started playing with the concept of royalties, especially after being exposed to Shark Tank and working a bit with Kevin O'Leary's group.
Oh, Mr. Wonderful loves his royalties. Wonderful.
Exactly. So I got into that space and I was like, okay, let's just see how we can apply that. Here I am 2 years later.
Excellent. So basically, companies are going to come to your platform looking to raise capital. They are not going to give up equity. They're not going to give up debt financing. They're not going to give up any control. What they're going to do is you're going to raise money in exchange. They're going to pay a royalty off the top. Can you tell me about the mechanism for how that works? What kind of royalty they're going to pay? How long it's going to last?
Yeah, for sure. We've positioned our product so that it kind of pay as you grow model. So we deploy the capital in a campaign. Let's just say 100,000, right? So let's say if you're a business that needs 100,000, come to us. We do all the underwriting, the analysis. Within 2 to 4 weeks, we'll be able to write a check. And once approved, we do up to 10 times your monthly recurring revenue, right? So if we're giving you 100,000, that means you're doing 10K MRR, and we funded you up to 10 times that amount. Once we decide that we're going to give you that investment, we decide on a term sheet based on your risk, your growth rates, your financials in general. There's different elements, almost 10,000 data elements that we look at.
10,000 data elements. We'll come back to that. Keep going.
Yeah. So yeah, that's a lot, eh? We're not doing it manually.
I gotta
So
say, it's a lot more than my bank asked me for last time. And
no, it's
yeah,
fully automated. Within
yeah.
5 to 10 minutes, we collect all that data. But ideally, yeah. So the investment terms would be anywhere 2 to 10 times your percentage of your revenue or top line revenue. So in exchange of the 100,000 we provide you, we'll take 2 to 10% of your top line revenue, which is a perpetual royalty. So it will continue forever until you decide to buy us out. And that buyout of the contract is 1 to 2x. So let's say we do 100,000 investment at 1x buyout and 5% royalty rate. That means I'm going to take 5% of your top line revenue until you decide you're going to give me back 100,000 on top, right?
Mhm. Okay, good. So basically, bottom line, it's variable because you're only paying it as you earn the money in the first place. So as long as the buyer can, or the person taking out this financing can, reasonably assume that they can even break even paying your top royalty, it's still cheaper than what you're currently looking at for, again, losing money or money or control altogether to debt or
Yeah,
equity.
exactly. So that's one thing that people keep saying is like, oh wait, isn't it an expensive option? Sure. If you look at it just from a pure cash flow point of view, like right now, yes, you are losing some of your revenue to pay off that investment, but you're retaining equity, and equity is far more worthy than a traditional royalty right now. Because if you look 5 years from now, when you have an exit, pretty much every round dilutes you by 20% or dilutes the co-founders by 20%.
Yeah.
But if you've like 100,000 costs you 200,000, let's say, or 250,000 over 2 3 years, it's still cheaper than 100,000 where there's no payment right now and someone takes 20% of your company. And
Well,
that's something a lot of founders can't wrap their head around sometimes. Like, oh wait, no, I'll just do equity because I get to keep my cash. But what do you want? Do you want to keep ownership or do you want to keep cash? You have to choose.
yeah, it's a delicate balance because cash is basically the lifeblood of any startup, right? But at the
Oh,
same
for sure.
time, again, if you're an entrepreneur, you're doing this because you believe that this is going to be an incredible upside to you. Giving up that upside is painful, right? And every time you do a funding round, you're basically there. Not only that, I've said it before on the podcast that when you take venture cap funding, you're basically on a treadmill, right? You have to hit a next target in order to qualify for another round of funding, and you basically are not really doing the strategic thinking yourself in terms of growth. You're basically following the venture capitalists' demands.
Exactly. You're trying to meet the VC's terms, right? Ultimately, these guys, we're venture backed as well, and it's a good model for some businesses, but it's not a good model for every business, right? But as
Especially
soon
if they
as you
don't
have,
have 1,000x upside, right? I mean, like these guys are looking for very big upside, right? So if you're content to basically say, you know what, this is going to become bigger than a lifestyle business, but it isn't going to be the next Facebook, funding that is going to be harder.
yeah, like let's just take an example: an on-demand flower shop, right? So an
Yeah.
on-demand flower shop is going to have all the good numbers and the revenues, but is it going to be worth it for a VC? And do you want to go to a VC, right? What's your exit strategy? Who's going to acquire you? When you're a good business model, you're going to grow. It's a SaaS or like an online marketplace for farmers to sell to basically people who want to buy flowers. But still, there's no exit strategy there. There's no 1,000x or 20x, whatever you want to call it.
No, and there's no IPO on that one.
Yeah, exactly.
Mostly 1-800 Flowers, which just had a hack also. So what you to do? Okay, so overall, so you said you've had founders basically come back and say, well, I'm having their trouble wrapping their head around. So what's been the general impression from entrepreneurs as to what you've been showing them?
We've actually been getting good feedback from entrepreneurs, especially that we're getting two categories of people, right? Or let's just say three. You get the folks that are not interested in venture capital. They know that they would never qualify for venture capital just because they're either too early for that, and they have the revenues but not necessarily for VC, or they have the revenues but not a good fit for VC. That's one side. And then there's two that they have all the numbers and they have everything, but these are guys who want to just hold equity for life and they don't want to give it up. They want to bootstrap the business and have some cash injections from lenders or people like us. So that's the second tranche. And then you have a third category where people are doing a hybrid. We're seeing some people do hybrid investments. I'm doing a 500,000 seed round or series 2 million Series A, but I don't want it to be fully equity. I want a portion to be debt or portion royalty, right?
Yeah.
So they come to us and they diversify their investment. So we're getting different feedbacks on that.
Okay. And I would think, we're talking about, smaller startup growth companies altogether, but I would have to think that this model might be compelling as well to issues like surrounding succession planning as well, right? If you have very profitable businesses and maybe debt, especially if you're in a services businesses, banks don't exactly want to give up lending to people who don't have hard assets. So, finding another buyer is not always easy. Sometimes you might be the better alternative altogether.
Yeah, so like our product is a perfect fit for cash heavy asset light companies, which pretty much banks turn down because there's no collateral and there's and if you need a personal guarantee for that.
Yep.
We don't do any of that, right? We don't need personal guarantee. We don't require collateral because we take top line revenue. So that's the kind of business we look at. We focus on software as a service, e-commerce, any business basically with a consistent source of revenue on monthly basis, right?
Excellent.
Now, if you tell me that you're more of a coffee shop that's doing a huge number and it's consistent, we'll probably still look at you, but we're more focused on tech-enabled online presence-based companies.
Yeah, things that don't have, again, like as you said, cash flow heavy and low overhead. Yeah, that makes a lot of sense. So I'm curious, how do you enforce the honesty in the system here, right? Because I'm guessing, obviously, if you weren't using some sort of tech-enabled solution, people could just lie to you about how much money they brought in every month, right?
Sure. Yeah, exactly. So that's why we don't deal with businesses that only accept cash, because there's no way you're going to.
There goes that coffee shop.
Yeah, exactly. So, when the business applies with us, there's three things that we connect to, right? One is their accounting systems. So with a QuickBooks Zero, other accounting systems down the road. We connect to their banks. So we have integrations with US and Canadian banks where we're able to get read-only data from their bank accounts. And payment processor data. So most of those companies would use, for example, like a Stripe, a PayPal, a Shopify payment, or they could be e-commerce, like they have an Amazon or Etsy, eBay, it's Shopify. So we connect to all those tools, and we also cleanse data online, like Crunchbase, it's social media presence, marketing campaigns, all of that. But the aspect of the financial data of revenues and how much revenue they made is based on those three pillars: the accounting system, payment gateway, and banks. And that allows us to monitor it on a monthly basis to figure out how much revenue they made, right? So that's why we ask each business to disclose everything from a revenue point of view and accounts point of view, and connect the ones that have the highest revenue in them. And then we monitor those on a monthly basis. And then we're building our own internal flag indicators. So if a business applied with you and their accounting system was showing 10,000 in every month on average, and it's suddenly 1,000 in, it's like, okay, they either switch accounting systems and now they're disclosing the revenues in something else, or their business is really going down. And that's basically a flag for us to go in and see what's going on. And especially that we have kind of insurance policy where we disperse our payments slowly. So if a business wants 200,000, we don't give the 200,000 in one shot. We have the optionality of dispersing that on 50K, 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 let's say. So that allows us to monitor and proactively show that. We have the right to call back the loan or the investment if we notice that there's tampering with the data. But ideally, we use on predictive analytics and fraud detection internally to see if they change their account.
So you suck it all, put all the data. You basically calculate what that what the revenue was. You probably give it based on AP an AR calculation. You probably give it some leeway to figure out a couple of weeks after the end of the month.
Exactly.
And then you ding the account automatically based on that and send them a statement of reconciliation.
Yeah, exactly. So we pick on the 7th business day. So the 7th business day of each month, we look at your last month's revenue just to make sure that everything has settled on your account and you've done reconciliations and everything. And on the 7th business day, we ping your account for the amount of revenue and take it out of your account.
Excellent. So
but like we're also friendly, unlike other lenders who will just take the payment out of your account no matter what, and they'll bring you to negative balances. We check your cash balance before it goes down, right? So to avoid any NSF.
Well, you're not. Yeah, that's the thing is that especially when we're looking at maybe payable cycles that might be prohibitive. You basically receivable cycles that might be prohibitive. There's nothing gained by dinging your partner here and making them incur bank fees, right? Like everybody loses on that one.
Yeah, and then don't forget, like each business might have a different payment cycle, right? Like let's say SaaS companies, you have some payments come in on the first, some payments come in on the second week, third week, fourth week. And then we take our payment on the first week. But let's just say that all your payments come in on the third week, then your first week payment is like I say, the first month, right?
Yep.
We already had skipped that high revenue curve of that month. So the first payment would be low, but the follower payments will be higher because all your revenue came in that month, right? So it averages out compared to a traditional lender. that takes a fixed biweekly payment, no matter how much your revenue was, there's periods where your balance can drop to negative, if not even worse, and that can stagnate your cash flow.
And if they're smart about it and they're looking at their accounting software enough, I mean, some of these like Xero will actually, you can program formulas into them, right? So you can literally program in whatever the revenue, the rate is times the top line revenue, and it can give them a running estimate as to what it's going to be before you even ding them. So that makes a lot of sense.
Exactly.
Yeah. So
that's one aspect of our platform, is that we're building all those insights and dashboards, so the business can come to us at any point, because we refresh that data daily. So they can come to us and say, okay, what's my projected payment this month to date? And we can see, okay, well, to date, you've made this amount of revenue. Your expected payment as of today is this, right? And
you might get be able to sell the dashboards after they're done. I mean, they're giving them better data analytics than they probably have themselves.
Which is good that you're bringing it up, because that's part of our product offering as well. We're not just offering capital, we're offering insights and capital, right? So when a business connects with us, sure, they connect that data for us to do the due diligence. But do you know how much of a hassle and a pain in the ass to connect to 4 different portals and study your analytics and your KPIs and measure them? So we consolidate all of that in one portal, and you can see your cost of acquisition, your LTVs, your churn rates, all of that.
So when do you spin off that business intelligence unit? Because there's another business. When do you spin off the business intelligence unit? Because that's another line of business.
Yeah, exactly. Right. Yeah. So that's a work in progress. We have the data already in the business. So we're just working on kind of flushing that interface out soon. But we do have a report that we can give to businesses as of today. Just it's more of a manual report at this point.
Sounds good. So basically 10,000 points of data. So let's talk about that. Besides the very obvious, what are some of the crazier things you look for, and what kind of information does that give you?
So as I mentioned, the first 2 things we look at is accounting system, payment gateways, and banking, right? So within banking, there's different divisions of data we look at. So your deposits, your NSFs, your OPEX, your expenditures, all of those. Mm-hmm. So we're not just looking at balances. Like on the payment process side, you look at your number of customers, how many customers you board a month, how many customers you lose a month, how many payments, how many of your customers, for example, they ask for a refund or a chargeback, right? Or someone disputes your payment. All of these are indicators. Accounting system, we look at your balance sheet, profit and loss, your number of employees, for example, that you board every month, how your payroll fluctuates. So that's just examples of financial data. I don't want to even break it down. I wish Derek was here. He'll tell you like every 10,000 one of them.
We tap for a while. The podcast isn't last time. Okay.
So on the marketing side, for example, we're able to tap into Google Analytics, your MailChimp campaigns, to see how your conversions, your bounce rate, your goals are converting, your engagement with mail, your newsletters, all of that kind of marketing to predict your conversions and your growth as a business.
Figure out what their funnel looks like, figure out what their conversion rate looks like.
We're able to look to your LinkedIn data, for example, the management, the advisors, all of that. We look at Crunchbase, Google Alerts on the business, just in case there's management resigns, right? That's a bad flag for us.
Yeah. So you mentioned AI previously. No doubt you have to use AI because you're not employing 10,000 people to basically monitor all this. So yeah, I'd be very curious in a couple of years to see how these algorithms all work out and what kind of interesting correlations on behavior and whatever you find, because it's almost like it's not a behavioral, it's almost a behavioral finance experiment, but internal to organizations.
Yeah, and it's a 5-year plan, right? We're not going to just claim now that we have all of that working right now, but it's a 5-year plan for us for the AI as the data gets bigger and more stable. But right now, I would say it's 50% AI, 50% manual, and that 50 will drop to 40, 30, 20.
When you say 50, I hope it's not 50% of the data points, because that would be a lot. But I mean, this is the common curve that technology companies do, right? I mean, commonly use the example of Lending Circle in the US, where they were like, the lending that they did was 85% correlated to FICO scores initially, and now it's like 30%, and they're lending to more people with lower default rates than FICO ever would have, and basically, again, through taking in far more data than anyone traditionally could have. So data is the new oil, and it can definitely enable you if you use it right.
Yeah, and that's like we're starting to see like traditional lenders or traditional royalty guys who do everything manual come to us as like, oh, you guys have a platform, you guys have pre-authorized debits. Like, forget about the data, just the fact that we have it.
That's the ability to actually to collect it, like in a pro. Wow.
Right. So same thing when we talk to banks, is like, oh, like they have they're not good. They don't claim that they're good at data aggregation and data cleansing because they're focused on the cash flow and probably the FICO scores. So that's like an interesting play for us at that point where it pushes us towards the licensing revenue stream down the road.
Absolutely. Absolutely. So, and it's interesting from an accounting standpoint. I mean, I'm wondering how does, anyway, I got to touch my tax account, but not going to bother you with that one. So what have the regulators said to you thus far? How's that conversation gone?
I mean, it's going well. Like part of working with the regulators is it's an educational and a working session, right? So they have to regulate you and kind of come up with the rules, but they also have to understand how the current technology needs to play with the rules. Unfortunately, when it comes to regulations, it hasn't been worldwide. Usually you'd think, okay, things will adapt based on technology, but financial regulation is the only thing that will never adapt based on technology. And you see technology adapting or having to play within that financial spectrum. Yeah. So we're lucky in Canada that the regulators have kept an open mind and launched the Canadian sandbox where companies like us can play within that sandbox and throw some good ideas out there of how to use blockchain or how to use new ways of funding within the current regulatory regime, right?
Yeah. So to their credit, they've been very open, and that's been the general feedback I've gotten, and from my conversations with them as well. It's quite different for a regulator to be open to this level of innovation and change. I mean, they're still ain't moving quick anytime soon. But that being said, they're telling you how to play within the current confines. So
and then that's been our mission from day one: be fully compliant. And that's one of the things that we don't use the word ICOs. We use security token offerings just because of the connotation it gives these days. But I mean, we followed the regulatory approach from day one, and it's funny because when our first meeting with the regulators, we just mentioned that hey, we're launching a security token, and they laugh because usually everyone comes to them trying to prove their utility token.
Yeah, it's like they never want to be called a security token because like, oh my god, you're going to be up my butt about this. Like,
yeah, exactly.
Well, so let's talk about the security token. Tell me about it. Purpose, functionality, when you hope to launch. Reception from the regulators, all of it.
Yeah. So as I mentioned, like to you, there's certain things we can discuss on the security tokens point of view. All I can say is that we've been working with the regulators for the past year now. Our token represents equity in our company. We're effectively going to be, once approved, obviously, effectively be the world's first public company to trade through a token, right? So Corl is going to be a public company once approved by the regulators. And one thing we can state for sure is that we pre-filed a prospectus, right? So usually when you go public, you have to do a preliminary prospectus followed by the full prospectus. But because of the novelty of what we're doing, we had to do pre-filing of a prospectus, so a third level, which they review and go back to us with questions. So we're in that phase right now, and we'll keep everyone updated as we are able to. But right now, from a timeline point of view, we can just say Friday. Which Friday? We'll see.
Fair enough. So that's an incredibly compelling conversation piece there. So end of the day, you are a publicly traded company, but you don't trade on exchanges. Then you solely trade over, or like not traditional securities exchanges. You're a token that changes over token exchanges. Is that the case? Or am I wrong?
Yeah. So when we become public after approval, we'll be able to trade on security token exchanges, right? So if you like Apple, Google, all these stocks, they try it from TSX, NASDAQ, and NYSE, right? So like there's traditional stock exchanges. You're starting to see traditional crypto exchanges like Binance, Coinbase, maybe CoinSquare down the road, I don't know, adapting to support security tokens. But we're also seeing traditional exchanges adapt to support that. So we've heard about NASDAQ, we've heard about TMX Shortcut, we've heard about the CSC in Canada, all having efforts right now to support security tokens. So technically, we can list on any exchange down the road that's going to support security tokens, even the traditional ones, once they support it. So the way
it makes perfect sense. Like, I mean,
you'll buy security token.
I mean, yeah, it makes perfect sense. I mean, like, frankly, security token, ownership, sale, and management is basically something that blockchain is a perfect fit for. So, I mean, it's a no-brainer to say that at some point in the future, pretty much every security will be a token. And that opens up some interesting opportunities because, I mean, things like fractionalization of shares, right? Like, whereas now,
self-sovereignty of your shares and all of that.
Yeah, now you have a couple of companies who will allow you to do fractional shares. Typically, some of the robos will do and stuff like that based on the custodial abilities. But in general, I mean, no more rounding errors. It'll be nice. So that's first that'll be now. Sorry?
And forget like as well. Like if you look at the security space, there's so many players, right? Like CompuShare, CDS, and the
Oh, yes.
exchange, the transfer agent, custodians, all of that are just, it's like, why? The blockchain is there, can facilitate that. But
Well,
if you
and,
apply
and,
the
they're, and you know
regulatory,
what? They're all waiting for disruption because they're all terrible experiences. Anyone who's ever tried to deal with them, and God forbid, like as usual, I always love when people basically have these things printed and leave them in a drawer and forget that they exist, or they get shredded or destroyed. And you get the contact with these companies to get them basically reissued, or or conversely, basically you had them on there and you forgot about them. Like it's a terrible experience start to finish, and it's one that is definitely, if it was more public facing, you probably would have seen disruption to it previously. But because it's in the background and it takes something as paradigm changing as blockchain to replace it, it's a big difference. It's a
oh
big
yeah, and I think these players are starting to notice that, and they know they have to pivot, and the industry is moving there. Especially that the regulators are keeping an open mind, right? But like, is that going to happen next year? I don't think so. I think this is a 5-year plan, if we're lucky, where you're not going to hear of CompuShare or CDS. I mean, they're useful and great for the current market, but if you're starting to tokenize assets, everything's on the blockchain. You don't need a
What's the
transfer.
point? We don't need you.
Your smart contract is that. Now, are they going to adapt to become more of an infrastructure company to support security tokens? That's something else. We'll let the future going to decide.
Yep. So that takes me back to this. So the funding is going to come largely from that raise, or did you raise it? You raised elsewhere for venture cap, right? So your initial pool of capital, venture cap. Okay. Have you been lending to date, or is this still in the works?
So we're planning to start investing in companies in, I would say, as of mid-January. But right now, we've built a network of partners around us. We're open for business, right? So businesses apply with us, and we'll do all due diligence. And we built a connection of capital partners around us where we can refer deals, right? So if we can't fund it ourselves right now, we'll just send it to capital partners like and royalties, VC, traditional debt. So we'll help the businesses in the meantime get the capital they need.
Excellent. So you've won at least one, if not multiple awards. Isn't that the case?
Well, we were nominated for the top 10 Canadian lenders of Canada, but we also won Toronto's best tech startup award for 2018. Yeah.
I mean, I talked to a lot of startups since the podcast. This is the first time I've seen this model done. I remember the first time we chatted, which was like a month or two ago. And I was like, I'm not quite getting this. And you explained it to me, I'm like, okay, this is quite brilliant. You're definitely coming on, because we're going to talk about both your security token and what it is you're going to do for businesses, which I find incredibly compelling. So a couple of questions to wrap things up before we finish. Ask everybody. So if you had one wish of something you can change right now in terms of your business or the industry, tech industry in general, what would it be?
I say maybe regulations, more of a open, one universal regulatory sandbox around the world. That's definitely.
Yes,
so it's like,
you need to make that happen.
Yeah, right. So like, if I get away, so it's like I have compliant in Canada, I'm compliant around the world. I don't deal with the SEC anymore in other countries. But that's my biggest wish, I guess, right now. And I think that's for me. Like I'm wishing something for our current blocker right now to move faster. But I would say that. But I'll stick to that for now.
Good. All right. And then the second one is, what do you feel the biggest challenge in getting to where you've gotten thus far has been?
I mean, it is like there's a lot of things you get into in the space where you have to learn as well and adapt. I think part of it is I've never claimed that I'm an expert on all fronts. So part of the challenge where I had to learn as I go. I started as a software engineer, switched to product management, and now I'm a guru. I'm a guru on securities law. So like that's been one of the challenges, like learning, like, oh, well, we want to do this, but oh, wait, we can't do it because the lawyer said we can't. So now you have to go learn how to adapt the product. So one of the challenges, you have your thinking hat on, but like, oh, wait, I can't do it because there's this chain here and there's this chain here. I can't do that. And I think that's been one of the toughest challenges. And the second is more, when you're doing something new, you have to explain it. So when Uber started, like, oh, wait, yeah, I mean, I'm not jumping in a cab. It's someone else who's giving me his car. So you have to explain the same thing for companies fundraising, right? Because most of the companies that come to us are like, oh, is it a loan? Is it an equity? It's like, no. It's equity, right? So it's a royalty, but it's different. And we don't take shares. We don't take board seats. Part of that challenge is more explaining the product. But that's as a team, we're working on kind of dumbing it down through our content on our website and messaging out there.
Excellent. And the last question is, what's the thing that excites you the most about what you're working on, or just the involvement in this community and in the business? Like, what gets you out of bed every morning, happy to be doing what you're doing? And you better be happy at this stage, because if not, you're in the wrong.
Oh, yeah, for sure. Exactly. Just a heads up for everyone listening. If you're not happy with doing what you're doing in the morning, so you probably should switch. No, what excites you the most is like talking to people and knowing how we're adding an impact in the financial world and the startup scene. Forget about security tokens. What we're doing there in security tokens is new and novel on its own. And it's definitely exciting, especially that it's always evolving, right? And I'm happy that we're one of the leaders in that space. But what excites me is that we're actually contributing, and I'm getting to do something that I had on my mind for the past 3 years, where there's better ways to revamp raising money, right? So not forget the technology, it's the product. And that's one of the things that excites me, that knowing few years from now, people would be talking about royalty and revenue sharing investments instead of just venture capital all the time. So
excellent. This has been fantastic. I encourage people to check this out. I mean, I am compelled to take a deeper look and think about how this can apply to my businesses going forward. I thank you for it, because I think this is going to help a lot of people. So well done.
Thanks. Yeah. And if you're a business looking for the next funding round, you need help, need just insights, please give us a shout. Check us out at corl.io, corl.io.
Yeah, and it'll be in the show notes. Thank you yet again, Sam.
Thanks for having me.
Yeah. So that was my interview with Sam Kawtharani of Corl. I'm sure for many of you, that was your first exposure to the royalty model and the ability to use that in various diverse types of businesses. I found it very fascinating, and I hope that they gain some traction. So with that, as always, thank you for joining us. And this has been FinTech Impact. If you enjoyed this podcast, please leave a review on iTunes, Stitcher, or wherever it is you get your podcast. Take care.
This podcast was brought to you by Woodgate Financial, an award-winning financial planning firm catering to high net worth individuals and their families. To learn more, go to woodgate.com. You can subscribe to this podcast on iTunes, Stitcher, and Google Play, or find more episodes at fintechimpact.co.